You're with The Capitalist Sage, a twice-a-month podcast that seeks out entrepreneurs and experts that speak to the real-world life of doing business for their sage advice. Now, with your hosts, Karl Barham and Rico Figliolini.
Welcome to The Capitalist Sage podcast. We're here to bring you advice and tips from seasoned pros and experts to help you improve your business. I'm Karl Barham with Transworld Business Advisors, and my co-host is Rico Figliolini with Mighty Rockets Digital Marketing and the publisher of the Peachtree Corner magazine. Hey, Rico.
Hey, Karl.
How you doing today?
Good. It's been a great day.
Absolutely. Today's guest is David Wood. He's with B2B CFO organization, and we're here to talk today about how to prepare your business for sale. How to increase the value of your business for sale. He's an expert in helping business owners navigate the waters to get their financials, to get their business ready for an eventual sale. David, why don't you introduce yourself and tell us a little bit about yourself?
Well, good afternoon, Rico and Karl, and thank you for the invitation to stop by. My name is David Wood, and I am a partner with B2B CFO. We're the nation's largest strategic and transitional CFO advisory firm located out of Phoenix. We've been in existence since 1987. There's roughly 220 of us partners around the country that give the advice.
Oh, excellent. Well, today's topic, I think, is really important for business owners to start thinking about as early as possible. And we figured, while we have you here, we could start exploring some of the things that business owners should start thinking about when they're looking for positioning their business for sale. First, how would you advise people to start thinking through that process? What are some of the first things they can start to do when starting to think about how to exit their business?
One of the largest obstacles I see that a business owner goes through when he tries to transition out of his business is that he's just not aware of the process that you have to go through. The process is very complex. It's very arduous. It is going to take much longer than the business owner typically thinks, and that time period is going to be in the 9 to 12 months range on average. It's going to take a little bit more money than what they originally thought. You can easily get upwards to $100,000 in costs that you're going to have to outlay while you're running your business before the sale. Mm-hmm. So it's just trying to understand the whole process, the timing, and what you're going to have to go through to really be able to wrap your arms around it and get through the process.
So why don't we dive in a little bit just to give people some ideas of some of the things that business owners should think about and start preparing for. Can you give us maybe one specific idea around that?
Well, one thing the business owner, I think, needs to start off with is to have and understand what the true value of their business is. Mm-hmm. And how do you get to that? There's over 20 million small business owners in the United States, or small businesses in the owner states. In the United States, over the last 10 to 12 years, there's been an average of about 10 to 12,000 of these businesses that have sold. I'll start off with, what's not the problem is there is plenty of money in Wall Street, and there's plenty of money to buy the businesses. But the business owner just doesn't understand the process, and he gets bogged down and has self-imposed limitations on himself because of his lack of knowledge. Mm-hmm. So one of the first things that we'll do with a business owner is to try to come up with a valuation and let the business owner understand how his business is going to be valued.
Oh, I know a lot of business owners, if you were to ask them what's their business worth, they'd have a number in their head, right. And they tell you, my friend down the street sold a business and it's worth X amount of dollars, and I think I'm better than they are, so it should be that. Right. What are some of the ways that buyers look at businesses when it's coming to values? What are some of those factors that factor in?
The buyers are basically going to be concerned with cash flow. So when a buyer goes and buys a business, to back up a second, there's different types of buyers out there. If you're looking at a true financial buyer, all he's worried about is a return on investment. So he is really going to be looking for cash flow, and that's what you see a lot of the Wall Street money. They aren't interested in what you do. They're interested in how much you're making.
Got it. Is cash flow different than profit?
Yes, cash flow is very different than profit. When you value a business, you use the most typical way of valuing a business is EBITDA, which is earnings before interest, taxes, depreciation, amortization. So in order to get back to the cash flow number where the business buyer is really interested in, you've got to convert what's really net income back into the cash flow. You have large differences in how you come up with that because there's just certain off-balance sheet items that come into play. Another thing that business owner that sells, especially if you're in a cash-based business, sometimes all your revenues aren't reported. All your cash income don't get caught up in revenues. There's some off-book accounting being done, and the business owner who's trying to sell doesn't just want to let that go by the wayside. He wants to capture that and get that included in what's eventually going to be the price for his business.
When you mentioned the original 100,000 cost at the very beginning, do you figure part of sales, that type of sales, in that cost, or that's even separate?
No, that's separate. The cost I was talking about earlier, Rico, was basically what are you going to pay your attorneys? What are you going to pay if you're going to go through an M&A or an investment banker or a business broker? What are you going to pay those people? If you haven't been audited,
right.
The buyer may require an audit, which may be a 3-year look-back period, so on and so forth. But those fees are usually, those costs come in big chunks.
Yep.
Now, those costs do come down, though, when it's a small business versus an investment banker type of investment. You're under, let's say, $2 million.
It's under it. Yes, they do come down quite. To some extent, they do. You're still going to have the legal fees involved. Right. You're still going to have an investment banker that comes in. They're going to take an upfront fee to pay for all their marketing to get your business out there. But that can be substantially less, especially if you don't have to get your books audited going back 3 years, if there's other ways to verify the income and the cash, which is more important than the income.
Right. Yeah, and in some cases, if there's real estate, you might have some stuff you have to do to prepare the real estate appraisal. There could be environmental concerns. So it's a range. Small businesses, it's often much less than that 100,000 if it's a much smaller business, but it's proportional. So it'll be some amount that folks may have to consider.
I just didn't want to get small businesses that might be hearing this to be afraid of, we're only doing $1 million in sales and it's going to cost me 100,000. But obviously that number does come down.
Yes, it's
yes,
much less.
It does. In my mind, I'm talking. If you've got a $10 million business or a $15 million business, then you're probably talking a different story. If you've got a business that's making $1 million in gross revenues, those costs, and what some of the reporting and what the buyer's going to be looking at, or you're not going to have the intensity there.
Because I figure the $10 to $100 million companies probably aren't doing the cash business the way the smaller businesses are doing.
Not.
we would be surprised on what's out there in the world. But getting back to that cash flow and kind of understanding, so if a business owner is not sure what the cash flow, they can get help with that to help them determine with that. What follows that?
The cash flow is very important to get that right. And where I think you're going with that question, Karl, is if you keep cash out of the income and you report your income, that's what the business buyer is going to look at first, is probably the tax return, because that's the lowest amount of revenue you're going to sign off on. Mm-hmm. And so what are the differences there? And not only keeping cash revenue off the books, but another thing that hurts net income from real cash flow is a lot of times business owners will take not tax avoidance, but just they'll run some of their family costs through the business, and that's typical. And it's not illegal, but it's not hard for a business owner to run a good portion of their automobile, for example, through the business. That the business owner thinks it's great at first because they don't have the tax liability, or it's lessening their tax liability. Where that hurts them in the end is when you use that net income number to value the business. If it's lower, then it's going to be a lower number.
And what buyers are often trying to do is just to see if it all makes sense. And if they're looking at a P&L, say profit and loss statement or income statement from a potential seller, if they see large amounts of money being spent, they just want to say, is this true? Is this accurate? Can you justify this? Can you explain this? For them to have confidence in the price they're going to pay for the business. So getting cash flow as accurate as possible helps reduce the unease and the risk to a buyer, and they might be willing to pay a higher premium for really good books that are accounted for well.
Right, and that's if you're a business owner and you're thinking about selling in the short period, you want to go back and make sure that your accounting records are in order. You want to have a good bookkeeper in place. Again, going back to your example, Rico, of a smaller business, it doesn't take that much, and that's something that a small business owner can learn himself. I don't want him spending, or wouldn't advise him spending a whole lot of times in the weeds. It's cheaper in the long run for him to spend a little bit of money on a bookkeeper to come in for a few hours a month, but to get the books right.
I think once every business owner, small business, has probably always looking for budget and stuff. So, they might be using QuickBooks online, and you're right. I think if you get the right accountant, they can set up the books in a way to categorize the expenses at the beginning. Right. So then you can pull out that category and say, this category is what we were just talking about before.
Yeah.
Let's clean it out by just pulling out certain categories, because you can create subcategories in QuickBooks.
Perfect example of a strategy that helps them capture some of those tax benefits they're trying to do, but also can give them a different view of their financial records to a buyer with easy searches and using spreadsheets and other things.
And being able to tie back into some third-party documentation, such as bank statements.
Right.
Which you will go through a due diligence process if you're selling your business, and during that period of time, you're going to feel like you're running around naked because you're showing everything to everybody. But part of that is the buyer will send in typically a small team to go through every single document that they can find to make sure that the cash you say is there is there.
So that's really helpful to kind of understand cash flow. There's another part of that equation when you're doing evaluation of a business, and there's a lot of different methods that's used, but a common one people will hear about is multiple of that cash flow. What goes into that other number, the multiple that a business might capture?
The multiple, the first driver, the strongest driver of multiple is what type of buyer you're selling to. And I think that's very important, and from my standpoint is to know who you're marketing to. And if you're marketing to a strategic buyer, that's going to be somebody that wants to come in, wants to take you out, wants to grow, maybe he's not in the local area and wants to be. So they're willing to pay a little bit more to get involved. You've done the groundwork, you've set up the infrastructure, and they just want to come in and take over it and combine with it what they have in another territory, or increase what they have. The second most typical type of buyer is going to be your equity buyer or your financial buyer. And as I said earlier, they're really not that interested. There's some interest, but the main interest is on what's the return on investment versus are they going to grow a current part of their business.
When you see buyers out there, I would say we typically see strategic buyers to financial buyers. Most buyers, to be clear, are financial buyers. And I'm talking possibly 95%. So a lot of business owners are looking for that strategic buyer, but just understand that's a much smaller buyer pool. And the whole point of a strategic buyer is that they can unlock more value with your business in their hands than you're able to by yourself, because they have complementary businesses, they have expertise in the industry. There's things that they're doing that the cash flow or the cash flow they can generate is higher, so they can do the math and say, you know what, I can pay a little bit more because in my hands it's going to be worth a little bit more. But since most business buyers are financial buyers, when you're looking at that multiple side of things, what are some of the other things that would factor in on that if you're a financial buyer?
Yeah, financial buyer, unlike a strategic buyer who already has management in place and using the economy of scales, a financial buyer may come in and not really have a deep knowledge of your industry or your business. So they want to see, one of the important things they want to see is, can your business run as efficient without you, the owner, being there? Mm-hmm. Part of that process is you want to be able to come up with a strategic plan, and including both internal and external factors of what's going on in the business. And you want to use that and analyze it, come up with a plan, and push that down and delegate down to your key management. So one main factor to push that multiple up, you want to be able to show that the business can run by itself. And part of that is you have 3 or 4 key managers in your business, or maybe just one, and let's say your sales guy, and he's coming up with 80% of the sales every year. If he's coming to look at you from a financial buyer aspect, and that guy is not under a contract, then his risk of capital input into your business is a lot more riskier, and your multiple goes down.
So having commitments from people like that, non-disclosure, non-competitive agreements.
Employee contracts are very strong here, having your policies and procedures written. If you have any intellectual property, make sure all that is protected properly. And
backups and all that.
Yeah, absolutely. Data backups. But I think you hit something, even if you started, what any business owner can do, a policy manual or operating manual for your business. I could see where you don't have time to do that. You can tell people what to do because you're there every day. Right. But when you make the decisions to start considering exiting your business, these are things that buyers value. If they walk in and they say, look, there's an operating manual that tells people how to do what they do. There's a policy manual in place. Correct. There's leadership that's been trained and established to run the business. The risk to them is lower, and therefore they're willing to pay a little higher premium.
Does it make sense then, if you know you're going to do this? You're the manager, essentially. Let's say you're the owner, the manager, you've done the leadership part of it. Does it make sense then to hire someone or bring up someone from lower in the ranks, if you will, to be the one to run it and take less money? Because sometimes businesses, you don't have a manager there, you're running it yourself. Right. How do you compensate that? Well, they're drawing whatever they're drawing out of there. But a financial investor wants to be able to say, well, you've committed $60,000 here. This person's going to be the one running. So if you leave, this is still running.
Yes.
Right.
Does that make sense to do that?
It does at certain points. You still want to. It's a tricky situation when you're in the mode during the 6, 9 to 12 month period that you still can't give up full control of your company just because you're wanting to buy it. But yes, if you are able to bring in somebody and at least start training them to come in and help out and take over the key management areas, then that's certainly going to help your multiple and increase your price.
You're touching on something that's really in big demand now. There's a lot of people that are working, have careers, and they're looking to invest in businesses, but they're not willing to or interested in leaving their main job or their primary. So they want businesses that can be semi-absentee owner or absentee owner. When they're looking at buying a business and they look at the financials of the business, if that expense is in there for that manager that's already running it, they would be, if it's not in there, they would be adding it in there because in their hands, they know they would need someone in there. Right. So as part of your transition process, bringing in that person adding to sales, adding to marketing to help drive the revenue higher, to drive more cash flow through it, really positions you for that really big population of buyers that are out there right now looking for investments outside Wall Street for their money.
Because they don't want to lose whatever benefits they have from that job, and that they know that they can move into that other.
Absolutely.
And at a minimum, what you'll want to do as a seller is to have the ability and the backup to show, if I sell you this business tomorrow, I'm going to be gone. And my $150,000 salary that I'm taking out of here is gone, but I'm going to replace it with a $75,000 salary. That just increased your EBITDA, your earnings, by $75,000 in that scenario. And if you throw a multiple of 4 on there, you just increase the $300,000 of what your purchase price is.
Absolutely. What you're saying in a lot of these, so looking at the financials and bookkeeping, looking at building out a team and organization within there to be successful, can't happen overnight. When should people start looking at making these changes, and what steps would you recommend even small business owners can start taking?
Yes, I am a strong proponent of Stephen Covey said in his The 7 Habits of Highly Effective People that you begin with the end in mind. So if you can buy a business and on day one have a strategic plan, knowing where you're going to have to grow and how you're going to get out, that would be great. That typically doesn't happen. So to answer your question, as soon as you know you want to sell your business, or even before then, it's always good to start planning. Because there's one thing for sure in every small business, and every small business owner, there will be a last day.
Can you share a unique story, maybe that quick? I mean, we're at the 5-minute mark, but maybe a unique story that you can share that illustrates some of that.
I do have a client, or I've had a client in the past where they were ready to sell. They thought they were going to sell. They had a strategic buyer bought their competitor for a multiple of 13, which is unheard of these days. And he had this vision that that was going to happen to him too. So over a couple years process, what we did is we started putting these elements in place that we talked about, getting some of the key employees under contract. Let's get your IP secured. Let's work on another thing we didn't mention earlier is that buyers love recurring revenue or contracted revenue. So something that's down as opposed to like a barbershop where a guy comes in and he may go somewhere else next week. So it was a process of about 2 years before we were able to, we had to get some items on the books cleaned up to show really what cash flow and what his margins were. But just going through and more or less, I called it peeling back the onion, and one step at a time trying to figure out what can make your business more valuable.
I always wonder when you mention strategic planning, people always come up with plans. I never hear someone say, I don't have a plan. But when you look at the numbers of their business, financial numbers, and you look at how well they did at executing that plan, you get a different story. What would you recommend for business owners to do to help make sure they're able to execute that plan?
Well, once you have a plan in place, you have to give accountability. And one of the best ways and most simplest tools that you can use for accountability is have periodic, typically monthly, meetings, and you have to take your plan versus your result, see what your variances are, and understand why those variances are there. And especially as you start to pass down some of the responsibility that an owner typically would take, you need to hold people accountable.
Well, there's a lot of great insights into there, and there's a lot more that I'm sure you can continue to share that help folks with that. But I'd love to know, what do you got going on? Anything going on in the near future that you want to share with folks?
I am. With B2B CFO, we do have a presentation that we give called the Business Sales Solution. And during that, we go over how to value your company and what how your valuation gets done. We go over different possible buyers and what the multiples that you would expect to receive on that, and some of the obstacles that get in your way into selling it. And if you visit me at David Wood at B2BCFO.com, where that's my email, or go to davidwoodcfo.com, which is my personal website, you'll be able to see when my next presentation is, which will be first week of May.
Is that in person or online?
That is in person.
Okay.
Right now we're giving it up. Giving it with another B2B partner, and it's over in the Cumming area.
Okay.
But I highly recommend folks starting to investigate this earlier, sooner. A little bit of knowledge can save you a lot of money in the long term and earn you a lot of money. Getting more knowledgeable about this. But I want to thank you, David, for joining us today. David Wood with B2B CFO. You gave us some good tips and advice that people that own businesses of all sizes could start to look. But more importantly, giving things for people to think about that they can implement into their own businesses to help them improve the profitability, which everyone tends to focus on, but also increase the overall value for whenever it is they choose to exit.
Right.
I'd like to thank Atlanta Tech Park for hosting the Capital Sage podcast. If you're looking to find a place to call home as you're starting a business and be surrounded by other small businesses and people that are growing and accelerating their business, it's a great place to take a look at, Atlanta Tech Park.
In Peachtree Corners.
In Peachtree Corners City. Thank you, Rico. And I'm Karl Barham with Transworld Business Advisor of Atlanta Peachtree. If you're looking for a consult on how to improve the value of your business, how to prepare it for sale, and or if you're ready to make the decision to sell it, we can definitely help you with a consult. I can be reached at www.tworld.com at Atlanta Peachtree or karlbarham@tworld.com. Rico?
Sure. I'm Rico Figliolini. I own Mighty Rockets. We're mightyrockets.com. Social media marketing and content. So anything along the creative line as well. I'm creative director. So creative services and social media essentially is what I work in. And I'm publisher of Peachtree Corners magazine in the largest city in Gwinnett County.
That's right. I know one's coming up soon. When can folks expect to see the next?
It's going to, God willing, we're in the midst of it right now. We're on deadline. It's going to hit the post office on the 4th of April. So hopefully your mailboxes, if God bless the mail service, will get it to you by the following week. And it'll be about 80 locations it'll be at. And we have quite a few things planned in it. There's going to be a real estate market story, a feature story about the residential and commercial real estate in the city, and a bunch of other stories that are really cool, I think.
Excellent. Well, thank you for doing that, Rico, and we're looking forward to seeing that. And we've got more podcasts coming up over the next few weeks. We've got guests booked out well into June at this point. We're going to cover topics on people that want to become entrepreneurs. We're going to talk to some more business owners. Yeah. We've got some folks we call makers, people that make things, and coming up with cool, inventive things that they're able to build into a business. So look out. You can follow us on iTunes. We're on YouTube. We're on Facebook. And
I think of Spotify, and I believe at this point iHeartRadio.
Yeah. So if you like us, please go on there, leave comments, and follow us, and you can get notified when the next episode comes out.
In fact, if you go to livinginpeachtreecorners.com, you'll see the player for the Capitalist Sage right on that website.
Awesome. Making it easy for folks to get access to this good information. Thank you, everybody, and have yourself a great day.
Thanks.
Thank you.
Thank you, David.
Thank you.
This has been the Capitalist Sage with Karl Barham and Rico Figliolini, the twice-a-month podcast with entrepreneurs and business experts. We hope you enjoyed this episode. Want more? Visit our website at capitalistsagepodcast.com.